Okay, so you've got this guy, Dave. Dave is a fund manager in New York. It's early 2026, and he's staring at a chart of the S&P 500. And the chart is basically a vertical line up for 2 years, carried entirely by maybe 7 companies. And Dave leans back in his chair, cracks his knuckles, and mutters to himself, "This feels exactly like 1999, right before the NASDAQ imploded." And the terrifying, fascinating thing is, Dave might be right. Or Dave might be the guy who missed the entire internet revolution because he thought Amazon was just a bookstore. That tension, that one question, is the entire AI debate right now. Not, does AI work? But are we paying for a revolution that hasn't paid us back yet? Let's just call the two sides of this argument what they are. On one side, you've got the bubble believers. These are the people looking at the price tags and screaming into a pillow. And they have receipts. You look at the valuations for these AI-heavy tech indices, these magnificent 7 stocks that now make up a cartoonishly large chunk of the entire stock market, and the numbers are stretched to dot-com era levels of absurdity. Price-to-earnings ratios, these fancy CAPE ratios, they're all flashing red. Regulators and big macro institutions have started issuing polite, bureaucratic warnings that basically translate to, hey, a 15 to 20% dive in stocks is totally on the table if people get spooked about AI. But it's not just the valuations being high, it's how the money is moving. This is the part that actually feels a little dodgy. The critics point to this thing they call circular financing. It's this weird feedback loop. Imagine a world where a huge tech company gives a chip maker a ton of cash, but that cash is structured as an equity investment. The chip maker now has revenue, books it, stock goes up. They then turn around and use some of that confidence to buy cloud services from the company that just invested in them. Everyone reports revenue, everyone's valuation inflates, and very little of that money actually touched the outside, real economy. It's like a group of friends passing the same $20 bill around a table and each one claiming they earned $20. That might be a slight exaggeration, but you get the anxiety. The fear is a lot of AI spending is being justified by other AI spending. And then you look at the scale of the cash going in. In the first quarter of 2025, something like 60% of all global venture capital deals went to AI. 60%! It's a feeding frenzy! Yet, and here's the punchline, when you survey actual companies, most of them are still just playing around. They're in pilot mode. They're experimenting. One major study found that only about 1 in 4 AI projects actually hits the expected return on investment for growth. About half hit for efficiency. So companies are spending millions on average per initiative, and it's a coin flip whether it saves a meaningful amount of money. This is classic productivity paradox territory. Workers feel superhuman. They're saving an hour a day. But when you look at the national accounts, the big aggregate productivity numbers, it's like a shrug. The macro data hasn't caught up to the vibe. Even the leaders, the grown-ups in the room, are getting nervous. Sam Altman from OpenAI has basically said parts of this look like a bubble. Sundar Pichai has said some of the spending is hard to justify. When the guys building the picks and shovels tell you there might be a gold rush mentality, you probably should pause. But, here's where you pivot. And this is where Dave, the fund manager, might just lose his job for being too cautious. The other side of this argument is so compelling it'll make your head spin. This isn't vaporware. This isn't pets.com. The "this is not a bubble" crowd looks at the exact same data and sees a productivity supercycle that happens once in a century. Their starting point is adoption. It's not theoretical. Nearly 9 out of 10 organizations now report using AI regularly in at least one function. That number was unthinkable just a couple of years ago. This has rocketed past checking it out into daily workflows. Enterprise leaders are not just prompting ChatGPT and calling it a day. They're building structured workflows, custom agents, using APIs. The consumption of these tools is going vertical. And the time savings are real, not hypothetical. The data from within enterprises shows heavy users saving over 10 hours a week. 3/4 of users say AI is making them faster or producing higher quality work. One report showed a 27% productivity improvement across measured use cases, with an average of 11 hours saved per knowledge worker per week. That's not a pilot. That's a full-time employee's worth of work back every month if you're using it heavily. It's just happening in pockets, not spread evenly across the entire global economy yet. The most powerful argument against the bubble thesis, though, might just be the economics. The cost of actually running these AI models, inference cost, is dropping like a rock. We're talking roughly a 10 times decrease per year to achieve the same level of frontier performance. Tiny, efficient models are now matching what massive, expensive models could do just 12 months prior. This blows up the argument that AI is just a game for the rich. It's becoming radically cheaper to deploy everywhere. And that's coinciding with capabilities that are genuinely jumping forward in reasoning and multimodality. It's a 2-for-1 special, getting cheaper and smarter at the exact same time. And here's the quiet part said out loud. Both sides, the screaming bears and the raging bulls, actually agree on the most important thing. They agree AI is transformative. They agree scaling is hard. They agree the short-term expectations are way too high. The real debate isn't if this technology will change everything. It's about timing and price. Is the market pricing in a flawless, frictionless 10-year future that hasn't happened yet? Almost certainly. Could we see a sharp, nasty correction that wipes out a bunch of overvalued, speculative AI junk? Absolutely. Look at what happened with the dot-com bubble. The crash vaporized the silly companies, but it didn't vaporize the internet. Amazon and Google crawled out of the wreckage and took over the world. So here's the spine of the whole thing. AI, the technology, is not a bubble. Parts of the AI market, the pricing, the hype cycles, the circular money games, that stuff probably is. The most likely burst won't look like the end of AI. It'll look like a brutal, overdue garage sale where weak projects and nonsensical valuations get cleared out, and the real value keeps building in the background. Dave might get his crash, but he might also miss the next 2 decades of growth waiting for it. If you want me to deep dive into which specific megacap stock is the most egregiously overpriced, or maybe break down which open source model just blindsided the entire industry, you know what to do. Hit that like button, yell at me in the comments about why I'm wrong, and subscribe so you don't miss the next late night spiral. Now, I need more caffeine. This was a lot.